Hey everyone, and welcome back to the Safe, Simple Sound podcast, College Planning Edition. I'm your host, Alex, and I'm really glad you're tuning in today. Our goal here is always to make managing your money feel more straightforward and secure, helping you build that solid financial foundation. Today, we're diving into a topic that's crucial for so many families and individuals planning for the future: saving for education. Specifically, we're drawing insights from a very helpful guide explaining the Qualified Tuition Program, or as it's much more commonly known, the 529 Plan. This guide breaks down a powerful tool designed to help you tackle rising education costs. A couple of things really jump out. Firstly, the significant 529 Plan tax advantages. We're talking about potential tax-deferred growth on your savings, and crucially, tax-free distributions when the money is used correctly. Secondly, it's fascinating just how broad the definition of qualified education expenses has become. It's not just college tuition anymore, covering things from K-12 to apprenticeships and even certain student loan repayments. And third, these plans offer real flexibility, allowing you to adapt as life circumstances change. Understanding how these education savings plans work aligns perfectly with our core beliefs here, especially seizing financial control of your future and understanding financial choices to make informed decisions. It's about making smart moves that are truly safe, simple, and sound. We've got a lot of practical detail to cover, aimed squarely at helping you, whether you're a parent, grandparent, or even planning your own future education. So get comfortable, maybe grab something to take notes, and let's get started on unlocking the potential of the Qualified Tuition Program. There is one topic that's on a lot of people's minds: paying for education. Whether it's for your kids, grandkids, maybe even yourself down the line, the cost of education seems to keep climbing. So how can we tackle that challenge proactively? Well, today, we're going to decode a fantastic tool designed exactly for this purpose. We're talking about qualified tuition programs, or QTPs, but you probably know them by their much more common name, 529 plans. So, what exactly is a 529 plan? Think of it as a specialized education savings plan. At its heart, it's a savings or investment account, usually sponsored by a state or sometimes an educational institution itself. The core purpose is super straightforward. It's designed to help you set aside funds specifically for a designated beneficiary's future qualified education expenses. That beneficiary could be your child, grandchild, niece, nephew, a friend, or even yourself. We'll get into what counts as a qualified expense in our next segment, but for now, just know it's a dedicated pot for future education costs. Now, why use a 529 plan instead of just a regular savings or investment account? This is where it gets really compelling. The primary driver, the big reason these plans are so popular, comes down to the significant 529 plan tax advantages. The first major benefit is tax-deferred growth. Imagine you put money into a 529 and invest it. As those investments hopefully grow over time, you don't pay any federal income tax on those earnings year after year. Think of it like a snowball rolling downhill. Without taxes taking little chunks out annually, it has the potential to grow bigger and faster. That compounding effect, uninterrupted by taxes, can make a huge difference over 10, 15, or 18 years. Let me ask you this. When considering the rising cost of education, how compelling does that tax-deferred growth sound compared to just putting money in a standard savings account where any interest earned is taxed each year, or a regular brokerage account where dividends and capital gains might be taxed annually? For many people, that tax deferral alone is a powerful reason to consider a 529. But wait, there's more. Arguably, the most powerful benefit comes when it's time to actually use the money. This is the concept of tax-free distributions. If you withdraw funds from your 529 plan and use them to pay for what the IRS calls adjusted qualified education expenses, those withdrawals, including all the earnings, are completely free from federal income tax. Let me say that again. The growth your money achieved over all those years, you don't pay federal tax on it when you use it for qualified education. That's huge. Compared to selling investments in a taxable account and potentially facing a hefty capital gains tax bill right when you need the money for tuition, the 529 plan offers a clear advantage. And there's one more potential perk to mention. While contributions to a 529 plan aren't deductible on your federal tax return, many states offer their own incentives. This could be a state tax deduction, 529 contribution, or even a tax credit for putting money into your state's plan. This varies wildly by state, though. Some offer great benefits, some offer none, and some only give benefits if you use their specific state-sponsored plan. So, this leads to a crucial point. You absolutely must check the rules for your specific state. Thinking about that leads naturally to another question. What initial questions should someone ask when exploring their own state's specific 529 plan offerings? Definitely check for those state tax benefits, but also look at the investment options available, the fees involved, and any residency requirements. So let's quickly recap the magic of the 529 plan. It's a dedicated education savings plan. It offers powerful 529 plan tax advantages, starting with tax-deferred growth. The biggest win is potentially tax-free distributions for qualified education expenses. And you might get a state tax deduction or credit for contributing, but you need to check your state's rules. All right, feeling motivated to look into this? Here's your action item for this segment. Identify your state's 529 plan administrator. This is often part of the state treasurer's office or a dedicated higher education authority. Then visit their website. Specifically look for information about the plans they offer and, crucially, any state-specific tax benefits like deductions or credits for contributions. Understanding those potential state benefits is a key first step. We really decoded the basics of what a qualified tuition program, or QTP, what most of us know as a 529 plan, actually is. And we touched on those fantastic 529 plan tax advantages, especially that tax-deferred growth and the potential for tax-free withdrawals. Super powerful stuff for building that education savings plan. But knowing why to save is just the first step. Today, we're diving into the who and the what. Specifically, who can benefit from these funds and the surprisingly broad range of expenses a 529 plan can actually cover. This is where the rubber really meets the road in terms of planning. So let's get into fueling the future, contributions, and qualified education expenses. First off, let's talk about who the plan is for. This person is called the designated beneficiary. Now, this is typically your child or grandchild, but the great news is it doesn't have to be. You can even set up a plan for yourself if you're planning on going back to school, or for a niece, nephew, or even a friend. And here's a key piece of flexibility that I think is incredibly valuable. Life happens. Plans change. Maybe the initial 529 beneficiary you name decides college isn't their path, or perhaps they get a full scholarship. Fantastic problems to have, right? Well, with most 529 plans, you have the flexibility to change the designated beneficiary to another eligible family member, like another child, a grandchild, or even yourself, without triggering negative tax consequences. That adaptability really reduces the worry of what if. Okay, so we know who it's for. Now let's talk about what you can use the money for, focusing on those qualified education expenses. When most people think of a college savings plan, they immediately think tuition. And yes, tuition and mandatory fees for higher education, think college, university, even eligible vocational schools, are definitely covered. But it goes much further. Think about the practical costs, required books, necessary supplies, and even essential equipment needed for coursework. Those all generally fall under the umbrella of qualified education expenses. But wait, there's more. The definition has expanded significantly over the years. Are you thinking about private elementary or high school? You can use up to $10,000 per year per beneficiary from a 529 plan to pay for K-12 tuition. That's a game changer for families considering private school options. What about non-traditional paths? If your beneficiary is pursuing a registered apprenticeship program, certified by the Secretary of Labor, the fees, books, supplies, and equipment required for that program can also be paid for with 529 funds. And let's not forget living expenses. For students enrolled at least half-time in a higher education institution, certain room and board costs can qualify. This isn't just dorm fees. It often includes off-campus housing costs up to the amount the school estimates for on-campus living. We're still not done. Think about the tools needed for modern education. The cost of a computer, any necessary peripheral equipment like a printer, educational software, and even internet access, these can all be qualified education expenses when required for enrollment or attendance. Expenses for special needs services for a beneficiary in connection with their enrollment or attendance also qualify. It's really designed to cover the reality of educational costs today. Here's another unique benefit, especially relevant for recent grads or families juggling multiple educational timelines. Since 2018, you can use 529 plan funds to make payments on qualified student loans. This applies to the principal or interest on the loan, up to a lifetime limit of $10,000 per individual. And that individual can be the 529 beneficiary or even one of their siblings. So, if one child finishes school with some debt, and maybe there are leftover 529 funds, or perhaps another sibling didn't use all theirs, this offers a fantastic tax-advantaged way to tackle some of that student loan burden. Just remember that $10,000 is a lifetime cap per person helped this way. Now, a quick word on getting money into the plan, the 529 plan contributions. While the federal government doesn't set a strict annual contribution limit, the total amount you can contribute is ultimately capped. Think of it this way. You can't contribute more than what's reasonably projected to cover the beneficiary's future qualified education expenses. Each specific 529 plan, usually run by a state, will have its own maximum aggregate contribution limit, often quite high, like hundreds of thousands of dollars. The key takeaway? Always check the rules of the specific plan you're considering or using for their limits. Okay, that was a lot of ground covered. Let's pause for a moment and reflect. Thinking about this really wide range of qualified education expenses, tuition, books, computers, K-12, room and board, even student loans, does this change your perspective at all on how much you might need or want to save in a 529 plan? Maybe it feels less daunting or perhaps even more essential. And specifically, how does knowing you could potentially use funds for K-12 tuition or for that $10,000 student loan repayment potentially impact your overall savings strategy or how you might prioritize funding a 529 plan versus other goals? So to quickly recap this segment, the 529 beneficiary designation offers great flexibility, and the scope of qualified education expenses is incredibly broad, covering everything from higher ed tuition and books to K-12 costs, tech needs, apprenticeships, and even a portion of student loan repayment. This brings us to a really practical next step. Take some time this week to start estimating the future education costs for your beneficiary. Don't just think about tuition. Consider all these different types of expenses we just discussed that a 529 plan can potentially cover. Having a clearer picture of the potential need is crucial for setting realistic savings goals. Welcome back to the Safe, Simple, Sound podcast. In our last segment, we dove into the nitty-gritty of contributing to your 529 plan and explored the surprisingly broad range of qualified education expenses these plans can cover. Everything from tuition and books to K-12 costs and even student loan repayments. It's exciting to see how versatile these accounts can be for fueling future educational dreams. But, of course, saving the money is only half the equation. Eventually, the time comes when you need to actually use those funds. And that brings us to our focus for this segment: accessing your savings, navigating distributions and tax rules. Taking money out of your 529 plan comes with its own set of important rules, especially concerning taxes, and understanding them is key to keeping those benefits you worked so hard to gain. So let's start with the basics. When we talk about distributions in the context of a 529 plan, what do we mean? It's actually quite simple. A distribution is just a withdrawal. It's the act of taking money out of the 529 plan account, usually to pay for those qualified education expenses we just talked about. Straightforward enough, right? But here's where things get a little more nuanced, and it's arguably the most critical concept to understand when taking money out. Adjusted qualified education expenses, or AQEE. Think of AQEE as your true out-of-pocket education cost for tax purposes. How do you figure it out? You start with the student's total qualified education expenses for the year. Tuition, mandatory fees, required books and supplies, maybe qualifying room and board. Then, and this is crucial, You subtract any tax-free educational assistance the student received during that same year. This includes things like the tax-free portion of scholarships, Pell Grants, veterans educational assistance, or maybe tuition help from an employer. Imagine the student racks up $15,000 in qualified tuition and fees, but they also received a $5,000 tax-free scholarship. Their adjusted qualified education expenses for the year wouldn't be $15,000. It would be $15,000 minus $5,000, which equals $10,000. That $10,000 is the magic number for our next point, which brings us to the fundamental rule of 529 plan distributions. Withdrawals from your 529 plan are completely tax-free only up to the amount of the student's calculated AQEE for that year. So in our example, the student could take a tax-free distribution of up to $10,000 from their 529 plan. This really highlights why accurately tracking not just the qualified expenses paid, but also all the tax-free financial aid received is so absolutely crucial when you start taking 529 distributions. If you don't track both sides of that equation, you won't know your correct AQEE, and that can lead to issues. Okay, so what happens if you take out more than the AQEE? Let's say in our example, the family withdrew $12,000 from the 529 plan, but the AQE $10,000. Does that mean the whole $12,000 becomes taxable? Thankfully, no. It's only the earnings portion of the excess distribution that's potentially taxable. Remember, your 529 account balance is made up of your contributions and any earnings it generated. When you take a distribution, it's considered partly a return of your contributions and partly a withdrawal of earnings. If your total distributions exceed your AQEE, you have an excess distribution. The plan administrator will typically send you a Form 1099-Q. This form shows the total distribution and breaks out how much of it was earnings. You'll then need to calculate what portion of those earnings corresponds to that $2,000 excess. That calculated amount is what gets reported as taxable income. The calculation involves looking at the ratio of the AQEE to the total distribution. The reference article we discussed earlier has a good example of this calculation, and IRS Pub 970 explains it thoroughly. You can see the potential pitfalls here, right? If someone takes a distribution without fully understanding this AQE calculation, maybe they forgot about a scholarship or overestimated expenses, they could inadvertently create taxable income for the student or themselves, leading to an unexpected tax bill. Precise record keeping is your best friend here. Finally, let's touch on non-qualified distributions. This is when you take money out of the 529 plan for something that is not a qualified education expense. Maybe it's a down payment on a car, a medical bill, or something else entirely unrelated to education. If you do this, the earnings portion of that withdrawal will be subject to ordinary income tax. Plus, there's typically an additional 10% tax penalty applied to those earnings. That penalty is designed to discourage using these education-focused accounts for other purposes. Now, there are a few important exceptions where the 10% penalty might be waived, such as if the distribution is made because of the beneficiary's death, disability, or if they receive a scholarship. But generally, using the funds for non-qualified reasons comes at a cost. So let's quickly recap the essentials for navigating 529 plan distributions. First, distributions simply means withdrawals. Second, master the concept of adjusted qualified education expenses. Total qualified expenses minus tax-free aid. Keep meticulous records. Third, remember the golden rule. Distributions are tax-free only up to the AQE. Fourth, if distributions exceed AQE, only the earnings portion of the excess is potentially taxable income. Check your Form 1099-Q. And fifth, avoid non-qualified distributions if possible, as the earnings face income tax plus usually a 10% tax penalty. Navigating these rules correctly ensures you maximize the tax benefits of your 529 plan. Because the details matter, I strongly encourage you, our listeners, to take the next step. Familiarize yourself with IRS Publication 970, Tax Benefits for Education. Pay particular attention to Chapter 7, which focuses specifically on qualified tuition programs. Look for the sections detailing the rules for distributions and how to calculate AQEE. It's the definitive guide straight from the source. Understanding how to take money out tax efficiently is vital, but the power and flexibility of 529 plans extend even further. What if your child decides not to go to college after all? Can you move the money to another sibling? Can you roll it over into a different type of account now? And how do these tax-free distributions interact with other education tax credits you might be eligible for? That's where we're headed next. Exploring the fantastic flexibility through rollovers, beneficiary changes, and coordinating your 529 strategy for maximum benefit. So let's dive into some of the really neat features that give you more control and potentially even greater long-term benefits. First up, let's talk about rollovers. Did you know you aren't necessarily locked into the first 529 plan you ever opened? Life changes, and maybe your plan needs change too. The rules allow you to move funds from one QTP to another QTP tax-free. This could be for the same beneficiary, maybe because you found a plan with better investment options or lower fees. Or you could roll it over to a plan for another eligible family member. Maybe a younger sibling is now heading towards college. The key thing here is that this rollover generally needs to happen within 60 days of the distribution from the old plan to maintain that tax-free status. Think of it like carefully moving your valuable furniture from one room to a better suited one. You want to do it efficiently and without breaking anything. Now, speaking of rollovers, there's a newer, really exciting development thanks to legislation changes impacting distributions after 2023. This addresses that common question: what if there's money left over in the 529 plan? For 529 plans that have been open for a good while, there's now an option for a tax-free rollover directly into a Roth IRA for the beneficiary of the 529 plan. Now, there are limitations. Annual contribution limits apply, and there's a lifetime maximum on how much can be rolled over this way. But wow, what a fantastic option! It turns unused education funds into a kickstart for retirement savings, completely tax-free. This is a game changer for long-term strategic planning. Another key piece of flexibility is the ability to change the designated beneficiary. We touched on this earlier, but it's worth emphasizing. Imagine your child, the original beneficiary, gets a full-ride scholarship. Or perhaps they decide college isn't the path for them right now. That 529 plan money isn't stuck. You can typically change the designated beneficiary to another eligible family member, another child, a grandchild, a niece or nephew, even yourself if you plan to go back to school, without tax penalties. This ensures the funds can still fulfill their intended purpose, funding education. Think about your own family situation. Can you see scenarios where being able to roll over funds to a different plan or change the beneficiary could be incredibly valuable down the road? Maybe you have multiple kids, or perhaps you started saving very early. This built-in flexibility is a huge plus. Okay, let's move to coordination. Specifically, coordinating your tax-free distributions from a 529 plan with powerful education tax credits like the American Opportunity Tax Credit or the Lifetime Learning Credit. This is where strategic planning really comes into play, and frankly, where things can get a little tricky if you're not careful. Here's the crucial rule: you cannot double dip. You can't use the exact same qualified education expenses to both justify a tax-free distribution from your 529 plan and claim an education tax credit. Think of it like having two different coupons for the same grocery item. The store usually only lets you use one. Similarly, the IRS wants you to choose how you get the tax benefit for a specific dollar of spending. So, what does this mean practically? Let's say you have $10,000 in qualified tuition and fees. The AOTC, for instance, is calculated based on the first $4,000 of certain expenses. If you take a $10,000 tax-free distribution from your 529 plan to cover all those expenses, you might wipe out the expenses needed to claim the full AOTC. However, with strategic planning, you might decide to take only a $6,000 tax-free distribution from your 529 plan. This covers part of the costs tax-free. Then you use the remaining $4,000 of tuition expenses to claim the maximum American Opportunity Tax Credit, which could be worth up to $2,500. By carefully allocating which expenses are covered by the 529 distribution versus those used for the credit, you could potentially maximize your overall tax savings for the year. So, if you anticipate being in a situation where you might qualify for both tax-free 529 withdrawals and education tax credits in the same year, how might you approach planning those distributions? It requires looking at the specific rules for the credits, the amount of your expenses, and your 529 plan balance. So, to wrap up this segment, remember the fantastic flexibility built into 529 plans, the ability to perform tax-free rollovers between plans, or even under specific conditions to a Roth IRA. Don't forget you can change the beneficiary if plans change. And critically, when it comes to education tax credits like the AOTC or LLC, remember you need to coordinate carefully. No double dipping on expenses. Engage in strategic planning to potentially maximize your total tax benefit by allocating expenses thoughtfully. Your action item from today's discussion. First, take a look at the specific rules of your chosen 529 plan regarding rollovers and beneficiary changes. Know what your options are before you need them. Second, if you anticipate needing to coordinate 529 distributions with education tax credits, especially the AOTC or LLC, this is an area where consulting with a knowledgeable tax advisor is highly recommended. They can help you navigate the specifics based on your income, expenses, and overall financial picture. Understanding these nuances really helps you leverage your 529 plan to its fullest potential. It's not just about saving, it's about saving smartly and adapting as life unfolds. And that just about wraps up our detailed look at the Qualified Tuition Program, or as most of us know it, the 529 plan. We really dug into the nuts and bolts today, didn't we? We started by decoding what a 529 plan is and why those 529 plan tax advantages, like tax-deferred growth and potentially tax-free distributions, make it such a compelling education savings plan. Then we explored who the 529 beneficiary can be and the surprisingly broad scope of qualified education expenses these funds can cover, from K-12 tuition right through to apprenticeships and even helping with student loans. We also navigated the crucial 529 plan rules around taking 529 plan distributions, emphasizing the importance of calculating your adjusted qualified education expenses correctly to maintain that tax-free status. And finally, we touched on the flexibility offered through rollovers, including that interesting newer 529 rollover to Roth IRA option and changing beneficiaries. For me, two things really stand out after reviewing this. First, the power of those tax benefits. Leveraging tax-deferred growth and tax-free distributions can make a significant difference over time. Second, the flexibility. Knowing you can potentially change the beneficiary or use the funds for such a wide range of qualified education expenses provides real peace of mind. Understanding these options is a key part of seizing financial control and making financial choices that truly feel safe, simple, and sound. Thank you so much for spending your time with me today on the Safe, Simple, Sound podcast. I truly appreciate you tuning in and being part of our community focused on practical financial understanding. Definitely check out the show notes. We'll have links to resources there, perhaps including a link to that IRS publication 970 we mentioned, and pointers on how to find your specific state tax deduction 529 info, if applicable. If you found this episode helpful, please consider leaving us a review, sharing it with someone who might benefit, and of course, hitting that subscribe button so you don't miss future episodes. We'll be back soon exploring another key financial topic to help you build security and confidence. Until then, stay informed, stay empowered, and keep making those sound financial choices. This is Alex signing off.